In previous episodes, I've gone over 3 complete trading systems. I showed you exactly where to enter, where to set your stop loss, take profit, and exit. Links in the description if you want to check them out. But I know not everyone is going to resonate with Ichimoku or Supertrend. We're going to start a new series with a blank canvas, and by the end, you'll see how to develop for yourself a profitable trading strategy. When I was a losing trader, one of the biggest mistakes I made was looking for that magical indicator where I could blindly follow whatever it told me. When that didn't work, I looked for the perfect combination of indicators. Here we're on the 1-hour chart. Price made a nice push up. We get a little retracement, and we notice for the last 12 candles, it seems to be finding support from this previous low. Jumping down to the 15-minute, it does look like we're starting to make higher lows, so we enter long. Switching over to the hour, we see price chop around for a bit and then crashes and we lose money. This never feels good, and we want to find a way to avoid this in the future, so we look to indicators to explain what happened. We find one that seems to explain the situation. We see that we entered during a blue candle, which we should have known it was choppy ranging markets. So from now on, we're only going to short on a red candle and only long on a green candle. The indicator seems to be working. Everything is still blue, and you can tell price is just moving sideways. So here we do get our green candle. We enter long now. The indicator did work for a little bit, but we still ended up losing money. So we go back to the drawing board and look for another indicator. So now it's starting to make a little more sense. We can see we're under the red ribbon. So as long as it's red, we're not going to take a long. You can see previously all of this was green. There was no shorts anywhere you wanted to take. We're not going to take a long until we have a green candle and a green ribbon. It's kept us out of a few more bad trades. We see the 2 green candles, but we wouldn't want to take those. So now the ribbon has changed. We got a green candle, a green ribbon, now we go long. Even using both indicators, we still lost money. So we go search for a third indicator. So now we're up to 3 indicators. As long as this down below is red, we wouldn't take the long. It would cancel out this green candle, this green candle, this green candle, so it does look like it's working so far. Green candle, green ribbon, and green bars below. So maybe this one will work. And it does look like price is going in our way. We could also get in over here, everything was green. So maybe we're onto something. Everything is red, but price moves up and you lose that trade. Maybe you enter right after. Everything is green, price moves down, you lose again. Price is red, eventually goes up. Price is green, dumps lower, and you lose all of those trades in a row. So you add indicator after indicator. Now you've got 4, 5, 6 indicators in a row. You're waiting for everything to line up. That's not the way you want to be trading. Before you put any indicators on the chart, there are 2 questions you have to ask. One is about the market, the other is about yourself. First thing you have to determine, is the market consolidating or is it expanding? Price is clearly in a range here. And this isn't a 1-minute chart, this is a 4-hour chart. So for the last month, price has basically not done anything. It doesn't matter if you use Ichimoku, moving averages, whatever trend following indicator you want to use, it's not going to work. But it's not designed to work in this environment. So according to this moving average indicator, this would be our short. Price goes right back up. Oh, we should get long. Nope, just kidding. Let's get short. Once again, we just keep getting whipsawed. Back and forth, back and forth, back and forth. Indicators are just tools. There's an old saying, when all you have is a hammer, everything looks like a nail. Ichimoku, MACD, Bollinger Bands, moving averages, they're all fine to use as long as the conditions are right. Step one is to think about the current market. But the second factor I think is just as important, but a lot of traders never even consider it. Some people spend so much time looking at the charts, they never have time to look inside themselves, consider their own personalities. Stepping away from trading for a second, in life, most people have a herd mentality. You're supposed to go to college. You're expected to work a 9 to 5. To me, clothes are just clothes. I'm not going to pay extra to have a brand label advertised on my shirt. But to some people, that's important, and there's nothing wrong with that. But if you're the type of person to take your cues from everyone else, just be honest with yourself. You bring a certain temperament into trading, and you may be more comfortable with a trend following system where you can wait for price to really be moving in an obvious direction before you jump on the train. On the other hand, there are people who are by nature contrarian. These are the rebels who think differently than most. Here's a chart that can demonstrate opposite viewpoints. See which one you resonate with. From a trend follower's perspective, we're clearly in an uptrend. This last candle looks super strong. What they might want to do is wait for the break of this line for confirmation and then go long. So we get our close above, that's our signal to go long. If price comes back down below this cluster, we're probably wrong. So there's our stop loss, and you can go for a 2 or 3 to 1. Price grinds up and eventually hits the take profit. So from a trend following perspective, this trade makes complete sense. Price is going up, you get confirmation, you enter the trade, and you make your profit. From a trend reversal perspective, this is where someone might get excited. From a trend following perspective, it'd be crazy to look for a short after price goes up and up and up. But from the trend reversal perspective, they're contrarian. They think the buyers have gotten a little carried away. They're looking to short when the price is high. We're starting to get lower highs. We have a market structure shift. This is where they would look to get short. Tagged into the trade, and it hit the take profit. In the last chart example, we saw both the breakout trader and the reversal trader could have made money in the exact same spot. A breakout trader wants to buy high and sell higher. If that logic makes sense to you, then develop your trading system around trend following indicators. Now, on the other hand, some people would feel very uncomfortable buying at such high prices. Reversal traders want to buy low and sell high, or short high and cover lower. But if you had to flip roles, the contrarian would be super stressed if he had to buy the highs, and the trend follower would think it's crazy shorting when the price has already gone up. By my nature, I'm more of a contrarian, and I brought that into my trading as a beginner. When price keeps going down, the people try to predict the bottom and buy. The slang for that is called catching a falling knife. There's a good reason for it. It's dangerous and you're likely to hurt yourself financially. Most of the time, I'd be wrong and lose money when I do it. But every once in a while, I'd get lucky. I'd draw my support, wait for one engulfing candle. Price would turn right around and I'd feel like a genius because I saw something the crowd didn't. But after a few blown accounts, I started to realize it's not smart to fight the trend. Even more than that, it can be extremely profitable to just wait for a big wave and ride it out. Ichimoku was the first trend following system I started to have consistent results with. But the one drawback of a trend following system is how late the exit and entry signals are. So here's our entry signal at the green. Overall price moves up, so nothing wrong there. Eventually price starts to move down and we get our exit signal. So overall, with perfect knowledge, this up move was 1,200 pips. Let's see how we did. We'd get in here, we'd get out here for about 425 pips. are only about a third of the move. And reason being, we were a little late getting into the trade and then a little late getting out of the trade. In this series, we're going to test and develop a profitable trend reversal strategy as well as a winning trend following system. So far, we've mentioned two things. Is the market more likely to be in a range, or is it expanding? Just as important, do you feel more comfortable trading a trend following system, or do you want to look into a trend reversal strategy? Once you're here, the road branches. Your system can use indicators, or you can trade a naked price chart. I think a good starting place for most people is to find a set of indicators that'll give you clues about when and when not to take a trade. I recently came across an indicator by Lune Trading that we're going to use in this series. They offer a whole suite of tools that use machine learning and AI to identify liquidity and analyze the market. One of the neat things is you tell the indicator your style and strategy and it'll customize the signals just for you. Confirmation is the trend following and contrarian is the trend reversal. Maybe you like a breakout strategy like we talked about. It tells you the exact indicators to use, even the settings. You can also trade smart money concepts with the indicator, a totally different set of indicator settings. You'd wait for the wave and the pulse. It tells you where to get in, where to get out, where to take your profit. I'll leave a link in the description to check out the indicator. Make sure to subscribe so you don't miss the next episode where we start to practically use the indicator to build out a trading system. For context, I posted a video about things to keep in mind when backtesting. I go over a few key points that all successful strategies must have. Click here to check it out. Thanks for watching. Talk to you soon.